In the next videos, we're going to talk about financial forecasting, which really is a continuing extension, if you will, of financial statement analysis. We now know the good parts, the bad parts of our business. The next thing we need to do is start thinking about how we're going to fix this. Where's the company going to go in the future? So we need to plan, right? So this is all about planning. Again, much of business is all about forecasting, right? I mean, if you think about any decision you ever make, it's all based on things that you think will happen in the future. It's a forecast, it's a prediction, right? So we need to make sure, though, that within this prediction process, that there's some consistency, right? Whatever our plan is, it has to be consistent. If there are changes to the plan, we need to know why we're making changes. This, of course, can come from the financial statement analysis. So the first step of this is a long-term kind of a plan, right? It's referred to as pro forma financial statements. So we're going to predict financial statements. So a major purpose, actually the primary goal of this whole thing is to establish what we refer to as the external funding required. I mean, if you think about accounting in general, some of us don't want to think about it too much. Basically, it says financial statements are created with a double journal accounting system, right? It's the debits and credits, creates this equilibrium so that when you're done, the balance sheet balances. In this prediction process, we're not using debits and credits. So we're not looking at individual accounts and recording them. So what we're going to do through this prediction process is create a statement based on some assumptions, not double journal entry. That implies that the balance sheet will rarely, if ever, will it balance from our prediction. We then need to talk about what's called a plug figure. So if this plug figure is positive, it implies that we need more money. If it's negative, it implies that we have more money than we need. Now, if you kind of think about a balance sheet, right? The right-hand side of the balance sheet, liabilities and equity, a way of thinking of this is all the money we have right now to buy assets. And total assets, obviously, is that number we're looking for. So we're going to predict how much assets we think we're going to need next year. We'll then calculate how much money we'll have. So if we need more assets than we have money, that means we have to go out and get some. On the other hand, if we have more money than assets, then we're going to want to save that money, right? We're going to try to do something with it, maybe short term. This overall process is something called the percent of sales process. We're going to forecast sales, and we know from looking at our statements that there are some assets that fluctuate with sales very closely. Accounts receivable, cash. There are a couple of current liabilities as well, like accounts payable. However, the remaining line items in the balance sheet do not fluctuate with sales. For instance, fixed assets. Just because you predict higher sales doesn't mean you need to buy more plant and equipment. So what are the steps that we need? We need to look at some historical data. That's where financial statement analysis comes into. We need to forecast some sales, find those items they think will grow in proportion to sales. We maybe need to forecast some other financial statement items. We need to figure out what the external funding requirement is, and then we need to decide what to do with either how to get the shortfall covered or how to use the surplus. So here we have a company. The average deposits, right, in this have been around $30,000. So their short-term renewable loan has been about $50,000 with a 5-year maturity. In late 2017, they want to ask for $500,000. Now, the company explains because of growth, accounts payable has gone up, cash balances have gone down. So suppliers are threatening to go, cash on delivery. So they need money, right? They think they need money. So the question, why the $500,000? I don't know where they got that number, right? So the pro forma analysis will give us a better justification for what this company actually needs, right? At this point, I don't think they really know what they need. So the first thing we need to do is look at their financial statements. Again, obviously, here are some things we need to look at. Here's sales. Sales have been increasing, but as you look down here, it looks like our profit margin has actually been decreasing. So something's going on with their profitability. So as managers, we'd like to know what's going on here. It appears, just looking at this, that there's an increase in cost of goods sold that seems not even, right? Sales are going up, but it seems like the cost of goods sold are not going up in the same relationship, actually maybe speeding up a little bit. So again, we want to look at the statements to see what's going on. If you look at their balance sheet, we can see that cash absolutely is declining. Accounts receivable is increasing, right? Increasing, it's actually going up. All right, inventory, it's rising. So that kind of lies. Look, we have increasing sales. Those things kind of make some sense to us. But accounts payable is really going up substantially. So what's causing all of this, right? What's the need of cash that's going on that's driving this need? They see growth in sales, but they see a reduction in cash. Their answer is we just need an influx of capital. Maybe, maybe not. Step 2 is we need to forecast their sales, right? So again, we need to really take a look at this process. If you look back at sales, right? Have sales, a 25% increase in sales is going to increase sales roughly $5,000, right? From last year to this year, it was $4,000, right? So again, that's about 25%. This year, $3,000. And so 25% each year doesn't seem to be totally out of line. Again, is that too high or too low? I don't know, right? So those are things that our business partners within the company, our marketing people, our production people, everybody has to be on board with trying to develop what a good growth number might be. Step 3, we need to forecast items that tend to grow in proportion to sales. So what are they? And if you look at these things on the income statement side, cost of goods sold, we have general selling expenses. We assume those are going to grow. And we also have these short-term items. Cash, accounts receivable, inventory accounts, all of these things have a tendency to grow pretty directly with cash. Now, taxes and dividends, quite frankly, don't tend to change, right? The dividends divided by earnings, that dividend payout policy, again, most companies tend to have that to be pretty stable. Maybe we'll talk about this in some later videos. But now we know what we're forecasting as the percentage to be, right? We need to figure out what we think that will ultimately be for this particular company. And I made that too small. Sorry about that. Too big. So in the next video, we'll continue on talking about how we're going to build this prediction model. But so far, we really have just looked at the financial statements historically and have estimated and forecasted from there. From what we see there, we have forecasted the next year's information. Look forward to talk to you soon.